All right, so hopefully we're live here. Dusty here talking about how you can position your real estate portfolio for retirement. And specifically, we're going to talk to the probably the smaller mid-size investors out there. So if you have under 50 units, and specifically, this is going to benefit those of you who have probably rentals that are 1 to 4 units, smaller units, right? So single family homes, duplexes, up to fourplexes. This will be of most benefit to you, but at the same time, I've helped a lot of people who own, 20, 30, 40 units as well trade into what we're going to talk about today. So I just real quick want to go over what we're going to discuss. We're going to discuss really quick how you can reposition what you have right now in real estate into something that is probably a lot more palatable and easy to manage for those of your family, right? So your heirs, your spouse. I get a lot of questions oftentimes. How do I get out of this jam because I've built this whole empire of rentals and so and so or my spouse, or, they don't know necessarily what to do. And I'm concerned that things may be mishandled. Maybe someone might slip and fall, and the equity might be lost. So we're going to tell you how to avoid that. We're going to tell you how you possibly, if you want to, you can actually have Starbucks or Taco Bell as your tenant instead of the multitude of very fine tenants, but ultimately probably not that well guaranteed tenants. And instead, Starbucks could be your tenant, Taco Bell could be your tenant, Denny's could be your tenant. We're going to talk a bit about that. We're going to talk a bit about how you can get rid of essentially all of your landlord responsibilities, everything that you're doing, tenants, toilets, trouble, we like to call it. We're going to try and offload all of that. Okay, so hopefully you can get rid of that. How you can probably, depending on where you're at, increase your income when you do this. Depending on where you're at, depending on if you're in high value location or if you're in the middle of nowhere America, possibly not, but we'll tell you how that works too. And this is again especially valuable for people who own smaller mid-sized rentals. So if you've got 50 units or less, this is probably a good idea to go after. A lot of times when I talk to people, their issue that they have is like, hey, I built this big portfolio of properties. I worked my butt off my whole life, 20, 30, 40 years. And when I hand this off to my heirs, are they going to be able to handle it? Right? Because they didn't go through everything I went through. They didn't go through all the experiences I know, how to avoid these problems. I know what to look for. How do I hand this off to them? My spouse took care of them. How do I hand this off to them without them, having a big mountain of things to handle when I hand it off? Um, Also, how do I get rid of the daily landlord minutia, as it were, so I can spend more time with my family? Maybe I'm spending a lot of time managing my rentals. Okay, so how do I deal with that? Well, the solution would be to either you can trade out of that. Okay, so yeah, I've got a bunch of rentals. I can trade out of those, and there's if you're not aware, you can do a 1031 exchange. Okay, this is an IRS approved way to trade all of your equity out of what you own and into a new property without paying the taxes, and you defer the taxes. Okay, that's key. Okay, you don't avoid them, you defer them until you don't exchange. So you can actually move your money from your property to another property without paying the taxes right now. That allows you a lot more buying power, so you could trade out, okay, into what I'm going to suggest. Okay, you could also, instead, you could assign full-time management control to a company or an attorney or what have you, and just kind of be fully hands off and let them take the reins, right? Someone who may, if you're concerned about your heirs, maybe someone who can kind of teach them and also take the reins in a full way without them taking them. But what the problem is that you're going to be a very big income hit from that. Okay. So if we're going to trade out instead of the management, right? Management's pretty self-explanatory. So if you're going to trade out of what you have, there's a couple ways to do that. You've got REITs, real estate investment trusts, right? So where you say, hey, I've got, $3 million. You've got a Walmart you're buying, or you have bought, and you're offering. I'm going to buy a 12% stake in your Walmart. Okay. And the REIT will give you annual returns. They will arrange the depreciation schedule. They'll do everything for you, but they're also going to handle the asset for you. So you don't get to control it at all. So that could be a problem, right? So depends on what you want to do. If you just want to hand out your money and someone else will handle it for you, that's fine. Deferred sales trust is another way. This would be if I wanted to cash out, but I don't want to pay the taxes right now. So a deferred sales trust. And we've actually got a video on the channel here that you can go and look at. But that's kind of a way to defer a lot of the tax consequences and arrange them the way you want. But you are going to have to pay a lot of those taxes eventually. You could also do what I'm going to suggest, which is trade into low or no management assets like Starbucks or Taco Bell. Here's kind of what that looks like. So we had for instance, a widow. She inherited a bunch of property. These were the leftovers that we kind of came into when we spoke to her. She had a couple vacant houses. She had a fourplex that was pretty much vacant, couple tenants. And she was, roughly making 14.5 in net income after taxes. Really, if she kind of rented them up, she could probably be around 40 or 45,000 in net income. So we helped her sell those, and she traded into a net lease property called single tenant net lease, Taco Bell, right? So she traded into that, about $80,000 in net income. So we're going to talk about a bit about that. But so for multifamily, you've got a couple things. You got single family homes, you've got 2 to 4 units. And then after 4 units, you have at 5 units plus, you're going to be what's considered commercial for lending purposes, right? In California, at least, after you hit 15, when you hit 16, you actually need an on-site manager. So you've got a lot of extra expenses that kind of need to be considered. Or someone needs to be considered an on-site manager at that point. So you've got a couple different categories. We're kind of focusing on the smaller end of this. And when you're investing in property, when we look at this, you've got a couple things. You've got a capitalization rate. Okay, so this is the return that I'm going to get, or the expected return, if I buy the property for cash. So a capitalization rate is if I were to pay cash, what percent of that would be my return annually? And it looks a bit like this. So if I had $1 million and it's a 5% return or cap rate, right? My net income is $50,000. $50,000 is 5% of $1 million. Okay. So when I'm looking at a property, an investment property, I'm looking at what is the cap rate or the return, and what's the market rate for that property type, right? So there's multifamily, there's retail, there's industrial, there's office, there's all kinds of stuff. But what is my average return for the current market for that property type? And those adjust. So just so you know, for net income, we've got our scheduled income. Okay, that is if everyone pays on time, every time for the full year, and everything's full. There's no vacancy. And then what we take from that is what actually the vacancy was and actually what we were paid. So if we were not paid some stuff, that's called credit loss. If we had some incentives, maybe there's a month free, et cetera, that might be an adjustment too. Okay, so then we remove the operating expenses. So we remove our vacancy, remove our operating expenses, and that results in what I get to take home and then get taxed on essentially for my net income at that point. Now, what that doesn't include is our debt service, right? So our loan is not included in that. Our capital expenses are not included in that. So if I replace a roof, if I replace all the windows with dual pane windows, that's not included, right? I don't do that every year. The operating expenses are only what we do every single year, and that's what results in our net income. And that is inclusive of our like our taxes, our property taxes, stuff like that. But it does not include those two or depreciation or amortization, just those specific items, right? And that's what's going to determine what our value is based on. But the problem is when we have small rentals like 1, 2, 3, 4, 5 units, we can't really use a cap rate on these things. A lot of times these ones are going to be determined by comps, right? So there's a lot of people who are going to live in them who are buying these things, not based off of what the return is, but I want to buy a house, I want to buy a duplex or triplex, and I'm going to live in there. What can I buy? And so the pricing is a lot of times driven by people who are going to live in the unit, not by people who are buying them for investments on these smaller, 5 or less units, oftentimes. So what that creates is an issue where the return on the investment is not driven by the price. The price isn't driven by the return on the investment. It's actually comparable sales. So that what that means is a lot of times our things are going to be wildly, or houses for up to fourplexes are going to be really underperforming. So just for example, my area, we've got a 3-bed, 2-bath, 1,300 square foot house that could sell for $500,000 very easily in this market. The income might be $2,250 per month or $2,700 annually. Let's assume the expenses, this is a very low assumption, are 30% of the income. Okay, so the taxes alone will be $6,000 plus, but let's assume that's the case. Okay, so that means our net income on a house in Sacramento would be about, almost $1,900,000. So if we do the calculation there, we divide the income into the price, our return annually is less than 4%. Okay, that generally speaking, that's a pretty low return. Okay. So you may have bought something before or far in the past. It doesn't matter what you paid for it originally. Okay, so you may be basing your return on what you originally bought for it. What matters is what you could do with the equity that you have right now. Okay, not what you bought it for. Okay, could you redeploy the equity you have right now and make more money? Oftentimes, especially here in California, the answer is yes. Okay, so for example, you bought something, a couple units, $1 million 15 years ago. Maybe you had a 15, 20 unit property. It makes today $100,000 in net income. Okay, maybe it's worth $5 million today. That's very conservative compared to how things have gone. Well, the return isn't 100,000 divided into what you bought it for. It's 100,000 in income divided into what you could do with that income. So that's 5 million, which means your return today is only 2%. This is why a lot of people cycle out their properties often, 5, 7, 8 years. This is why you should too. I'm not even going to go into depreciation, but that's a big issue too. Right? So the return is not 100,000 into 1 million for a 10% return. It is really, in this case, just a 2% return on your equity. Okay, so hopefully that makes sense. You got 5 million. How could I redeploy this 5 million to benefit you? And in this market, I could redeploy it very well, much higher than 2%. I guarantee you. All right. That's why I do net lease assets. So you've got low or no landlord management responsibilities. And then you also have the tenant who's going to pay all of your expenses. Okay, so on an absolute net lease, I'll show you what these look like. They're going to pay the building insurance, the property taxes. They're going to pay all the management, the maintenance, all of the utilities, all of the repairs. Everything's going to be paid by the tenant. They're usually on 50 to 20-year leases. There's rent increases built in, and they're usually guaranteed by a very high net worth individual or company. Here's one. Okay, I like the fast food. It's called a QSR, right? So Burger King here, one tenant, one building, they pay the rent. This is a tenant. This is not an owner, right? So usually the owner of this building is going to be an investor. The tenant will be Burger King or Starbucks, for example, right? Here's, I think we did that before. Here's a different example. We took 5 properties in San Francisco Bay Area, Richmond, actually, if you're familiar. It's a kind of a downtrodden area. It's not very, high end, but we sold 5 of the properties there. We bought 2 properties for them, a Burger King and a Dollar General. Those are the actual properties there. And we traded what was $80,000 in net income on the left for $131,000 in net income. And you can do that too. Like, you can trade a lot of times, the rental owners trade these things out. We usually get more income, right? So my most asked question is, no, you don't own the business. You don't have to flip burgers. You're the landlord. You don't own Burger King. Burger King's your tenant. Okay. So let's use a quick example of an actual property. So here's Denny's that was for sale for 1.8, cap rates 5.25, net income of almost 96,000, right? Here's a for sale in Long Beach, 5 units, okay, 2.1, almost 2.2, cap rate of 4, net income of 88. Here's how that shakes out, right? So we sell the 5-plex, we buy the Denny's. You can see right there, lease term is 20 years on the Denny's. You've also got 4 or 5 years options to extend, so they could be in there for 40 years. The guarantee is by a 22-unit franchisee, so someone who owns quite a few units. Net income of 96,000. Landlord responsibilities, pretty much nothing. On your 5-plex, you've got a 1 year or less lease for each unit. The guarantee is by, someone who, is probably, unfortunately working paycheck to paycheck, right? Net income, 88,000. All of your responsibilities are taxes, insurance, management, maintenance, utilities, repairs, garbage, water, sewer, all of that. Okay, so you could trade the 5-plex for the Denny's. Here's what's cool too. On that trade that we just looked at, the Denny's purchase, you actually have $347,000 left over. That's called boot. Okay, so you have to pay taxes on that, but that's boot. So in addition to all the cool stuff, you have this boot that you have to account for and pay taxes on. And you get to pocket probably 150 of that. Your income increased by 8,000. You got a 20-year lease. You got rid of all of your owner responsibilities, and you've now insulated your equity from quite a volatile rental market. If you want to learn more about that, we wrote an ebook. We get the same questions every single time. retiredinvestorbook.com or theretiredinvestorbook.com. I think we should have a link there for you as well. This is how you find these type of properties. These are the search engines that you can go on to. If you have any questions that you would like to have answered, happy to answer them. Happy to take a look at your current equity position, see if there's any adjustments made. It doesn't have to be this specific thing that I'm talking about. It could be something, maybe you can increase your income or decrease your expenses in different ways. Happy to help with that. We do kind of like a health report on your property. You can connect with us at theapartmentdoctor.net or at my email, dusty@theapartmentdoctor.net. Hopefully this helped. We will see you next time.